Welcome to Money Hangout once again. Uh, every week we interact with you to help you understand mutual funds better and answer some of the questions that you may have. Today we are going to talk about something which, based on the whole idea came from the big campaign about mutual fund awareness, which was launched by the trade body of mutual fund, which is AMFI. Uh, AMFI launched a awareness campaign about mutual funds, which is Association of Mutual Funds of India. And we started watching some small stories, 30-second, 40-second stories, where one of the other people in the conversation tells it the whole ad, the campaign, the individual ads, they conclude with mutual fund Sahi hai. And this has the potential to raise great deal of curiosity, great deal of awareness. A lot of people will start asking, but I know what people end up asking. I face this question all the time, that once somebody has understood that mutual fund is something worth considering, then the next question is, Kaunsa mutual fund sahi hai? Which one to invest in? And I think a significant, the biggest contributor to this question, or the answer to this question, is not, I cannot give you this answer. I don't think any expert can give you this answer. I think the expert, you are yourself the most important person who should contribute to seeking that answer, because uh, choosing the best fund comes after, once you have decided which kind of fund that you require. And this is primarily dependent on two things. One is your investment time frame and your own experiences. By experiences, I mean, if you have never invested in the market, if you are not aware of, or if you have never experienced the volatility of the market, if you have not known it for a while, then your attitude, or your reaction to what happens to market linked investment might be very different. Once you are, you have been invested, and you have invested for 2-3 years, and you have seen market go up and down, or the way you have invested in the past, that is a big contributor to your dislikes and likes, and your ability to stick to your plan. So choosing the best fund will disappoint you if you are not choosing the appropriate fund. So with that in mind, uh, you have to decide it first. What kind of investor are you, and for how long are you going to stay invested? When are you going to, likely to need that money? This is most important thing. Then comes the best fund for you. And this is where value research has played a critical role. Since 1993, we started rating mutual funds, and mutual fund ratings in India, uh, the Indian investors trust this rating. They have used it as a guidance, and we have refined this methodology over a period of time. This is the oldest guidance which has been available to Indian investors and available in the public domain, and investors use it very intensely, some for the right reason, some for the wrong reason. And today I am going to, as a step towards the, Kaunsa mutual fund sahi hai, how value research mutual fund ratings plays a role in helping you choosing the best one, choosing the right one, choosing the appropriate one. One is to, before I get into how to use it, an important thing is to understand what this mutual fund rating is. Mutual fund rating is nothing but a composite measure of risk and return as well. Everywhere you see the return, everybody knows that this fund has given 20% return over the last 1 year, 25% annualized return over the last 5 years, whatever. These numbers are available, but you have plenty of numbers available. Then you also get a sense of, the character of the fund, how the price behavior has been over a period of time, depending on, how volatile it was. And, you will get a lot of pointers to how this fund, how various funds, with various ratios, Sharpe ratio, alpha of a fund, which basically tells you how the fund has been able to, what kind of value it has been able to add beyond the systemic risk that it assumed. So all those are fine. But because there is a plenty of things to choose from, we devise these ratings as a composite measure of risk and return, so that it is basically an assimilation of many variables. You look at a fund which goes up from 10 to 20 with great stability, and another fund which goes from 10 to 20 in the same period of time with extreme volatility. In our method, the fund which does it with great stability will get a 5-star, and there is a possibility, depending on the magnitude of ups and downs in the life of the fund, with similar return, that fund can well give you exactly same return, but can get slotted as a 2-star fund. And there is a reason to it. Why we did it was, investors' distaste for negative return more often, as demonstrated in the past of a fund, is far greater than the positive return. Let me just explain you. If an investor gets 10% return, your 100 rupee becomes 110, you feel happy. But your 100 rupee becomes 90, you become very unhappy. So our distaste for negative return, our distaste for our loss aversion, our distaste for the decline in value is far greater, and that affects our behavior. And this is what we have tried to factor in our rating. Then comes how to use these ratings. Of course, there are a few other things. One is that all these ratings are valid only for a certain kind of fund. So when we are talking of large cap fund, the fund which invests only in large cap stocks, it is valid only for that. So don't do a cross comparison. A 5-star small cap fund is very different from a 5-star large cap fund, or a 5-star short term debt fund is very different from a 5-star dynamic bond fund. So they are all within the category. The rating is primarily trying to tell you is that these are the funds among a bunch of similar kind of fund, which have done better with greater consistency in the past 3 years, 5 years, 10 years, and so on. Then comes how to use. Of course, there's one more advantage, that we do not rate funds till we have enough number in a category. So unless there are 10 funds of a similar kind, we do not do the ratings. Until the funds get at least 3-year-old, we do not rate those funds, because a fund must have some meaningful background for you to actually form an opinion, even on its price, on its uh, on its the way it has tracked its benchmark, the way it has done against its peers. So these are two things. This in itself actually causes brings in a very desirable filter. How to use these ratings? I would say that don't use these ratings as the only way to look at to choose a fund. But these ratings are very useful from two standpoints. One is that they help you weed out a crowded universe. There are 50 large cap funds, there are 70 large cap funds. And it's not possible for you to analyze and look closely all these 70 funds. So knocking the lower rated funds, you have a more credible history. You have a credible list, smaller universe for you to choose from. And once you come across that smaller set, apply your thought on 2-3 things which I will state little later. But 2-3 things which you have to see after rating. But before that, it helps you limit your universe. The other thing which the rating does is, we do a continuous monitoring. Once you have invested based on a rating, after we have invested in a fund, we don't know when to actually revisit it, when we should review it, when we should review our decision, that have we done a good job. Rating acts as a good reinforcement. Once you have invested in a 5-star or a 4-star fund and it remains like that, which means this fund continues to do well relative to others in somewhat the similar way. And because it is a broader bunch, we are not giving a precise ranking. When you are looking at a ranking, it can still be confusing. You are looking at 1 out of 72, 2 out of 72. So you can't make sense of, is 7 out of 72 is bad or good. By bundling them together, a 5-star is basically top 12.5%, which I think is a good enough rough bundling of, because it's very difficult to guess which one will be the best one. it is very hard to guess which one will be the best performing fund. And in fact, if you ever get to figure that out, that this fund is going to be the best performing fund over any time period in the future, do nothing, invest only in that fund. But it's very difficult to do. I would say that it is impossible to do. All we are trying to do is remain invested in a good fund and be wary. You will get an alarm, or you will get an alert or a gentle reminder based on use the rating change as a gentle reminder for you to review and revisit. And because we revise these ratings every month, you should use it like that. After you have chosen, you have zeroed in on a smaller universe, 3, 4, 5 funds of the right kind for yourself, then you should look at 2, 3 things. One is that, is the fund manager, because our ratings do not factor fund manager changes. So is the fund manager still there, and has he been around? Because if you are looking at the 5-star fund and the fund manager left 3 months back, I would say that the likelihood of that return being sustained over a period of time may not be as high. So it should definitely be on your alert. You should be watchful. So fund manager, you should still be wary about. And next important thing is, once you have looked at the ratings, you have looked at the fund manager, then I think looking at how clearly that fund has devised its process in terms of has the fund articulated its don'ts, what the fund will not do and what the fund will always do. I think these rules comes in very handy. A great fund generally happens to be the one which is managed by a skilled fund manager who is bound by a rule, because most good fund managers, if they are not bound by the rules, they go haywire, or they get indisciplined, or they go wrong somewhere. Some of those rules actually comes in very handy. Which are the kind of stocks, or which is the kind of segment of the market which the fund will not invest in? What the fund will never do in its life? What kind of stocks will the fund always choose? Or what kind, so having those, if you come across those articulated rules, go for it. If you don't come across that, I think that is something which I really wonder that will be sustained over a period of time, irrespective of fund manager changes. So these are 2 things. And then the life of these ratings, how long this fund has been a superior performer on a risk adjusted basis. One is to look at the rating itself. The other is how well it has done over a period of time, the longevity of these ratings, sustainability of these ratings. If a fund has been a 5-star and has been a 5-star for a long period of time, I would say that the fund has been doing something remarkably well to be there. So these are the rules which you should follow, and I think you are well on your way. We provide you all these things so that you can yourself choose the best fund. Kaunsa mutual fund sahi hai, you can figure it out yourself. You have the best incentive to do this, and it is not very hard, because value research provides you the ratings, the changes in the ratings every month, and all the information which will equip you to pick the right one. There are 2, 3 things which you should have in mind, which I think it is important for you to understand. That limitation of the rating. The rating is based on past performance, and this is past performance. Future is uncertain. So this is something which you should have in mind. The other is that we are, with full understanding, we like a fund, or we think that it is a better fund if the fund provides greater stability. And our definition of stability is that the unstable funds are the ones we penalize a fund which goes down more often. If a fund declines in value more often relative to its peers, we dislike those funds. So if there is a possibility that there is a fund which goes up from 100 rupee to 300 rupee in 5 years time, and there is another fund which goes up from 100 rupee to 200 rupees in 5 years time, but there is a possibility that the one which has gone from 100 to 300 rupee with extreme volatility, with extreme wildness, it may not be the top rated fund. it may not be a 5-star fund, but the fund which has done with great stability might remain a 5-star fund. So just take it to your heart that this is a composite measure of risk and return as well. And most of the time, we are guided or we are attracted by the returns only. Risk is important, and on a full market cycle, risk catches up. So be wary of that. This is what it is: a conservative quantitative method to figure out the relatively stable ones. And I think it's a good starting point for you to start start looking for funds and in most cases you need 3-4 good funds, and it is important that you are involved in the process. It helps you you know stick to your plan. It helps you develop a belief in that, and that I think is the most crucial element in building long-term wealth. So thank you very much for your attention, and I look forward to your questions.
Thank you, Dhiren. Our first question comes from Mr. Sharma. He says that he encashed all his mutual funds as a precaution against the proposed capital gains tax ahead of the budget. However, he didn't invest back immediately, and now the Sensex has gained about 10% while his huge surplus is lying idle. What should he do?
He should not. He should. I was also warning people to take that money out, but the whole idea was that you will be invested again, and you should have invested immediately. But now that the market has gone up by 10%, uh, nevertheless, invest in the next 3-4 months. Don't try to time the market. You should not have missed this 10%. You should have taken the money out and invested it back again. That was my suggestion too at that point.
Moving on, Kanishk says that he picks funds based on their performance ranking, but after every purchase, the funds which he didn't pick seem to do better. What should he do? I mean, luck factor aside, is there any specific advice for him?
Yes, he should stop doing what he's doing right now, which is he should not be, he should choose 1 or 2, 3 funds and start investing, give it some time, and not look at other funds in brief period of time. If you watch funds on a day-to-day basis, you will have great regrets, or you will be uh, unnecessarily happy, because many a time the fund that you have chosen will also do well, but that is completely baseless. And I don't think you should derive happiness or be sad about the day-to-day noisy movement that we see in the market. Choose a good fund, invest regularly or invest lump sum, and give it time, and don't watch it every day. Doing this exercise, looking at funds on a day-to-day basis and trying to see that which fund has done well, there is absolutely no basis to it. And even if there is a basis to it, you can't do anything about it. So choose a fund that you like, choose a fund of the right kind, and be at it, and do this evaluation. You should do this comparison for 3 years period, for 5 years period, for the SIP return over a 5-year period when you have actually done that investment. That thing will be helpful, but that will still be of academic reference. Watching on a watching it more often is a futile exercise. Keep away.
Our next question comes from Ajay. He says that most large cap funds appear to have similar holdings. So how does he choose the best ones?
Don't look at holdings. Look at long-term returns, how volatile it has been, and that should be the primary guidance. And because looking at, if you look at the large cap universe, you come across about 70-80 of them. There are 20-30 funds which are which are not even able to match the return of the index, and in the middle are the index funds. And you see that there are long-term winners. You have funds which are able to beat the benchmark by 8-10 percentage point difference, 8-9% annual difference over a 10-year period, over a 5-year period. And at any point you look at their portfolio, they will look alike. So fund managers add great value by keeping away from some stocks, by emphasizing some other stocks in their portfolio, and that is a significant value addition, even though the portfolio might look alike. So don't look at portfolio. All large cap portfolio will always look alike.
Next up, Swati asks, what funds are suitable for a 34-year-old single mother with a 3-year-old child? Her goal is to provide for her child's education and her retirement.
As I was saying earlier, that it is a function of your requirement, and your requirement are very well articulated. For a 3-year-old child and your own retirement at 34, you have many years to go. You have 20, 25, 30 years to invest for your retirement, maybe 17, 18 years for your child's education. So definitely equity. But if you are a first time investor, start with a balanced fund, remain invested or do your SIP in a balanced fund for next 2-3 years. And after that, consider a multi-cap fund, moving your money as well as investing new money there. By that time, you will be experienced enough. Take this seriously, because whatever we may say, whenever we face a decline in value, markets are like that only. Markets will decline when you least expect it. And for a first time investor, reconciling with the losses in a brief period of time gets difficult. So it's important to develop your belief with the right kind of fund and then move to the ones which will be most rewarding. And you have all the time on your side. So start with a balanced fund. 3 years from now, move to an all equity fund.
Moving on, Rajiv says that his family's bank deposits also serve as collateral for business loans at times. Will this function be served in mutual funds as well, Dhiren?
You should ideally not do this. I always discourage investors to never to borrow money to invest. When you actually put it as a collateral, it effectively or indirectly amounts to borrowing to invest or borrowing elsewhere by putting your assets. And there is a problem with that. The problem with that is the collateral is a real threat to your investments. It actually hits you if your business somehow faces a downturn and you face a crisis. The collateral has a purpose, that this is something which will be called, or you will be asked to put more collateral. So if it is on, but if it is on a infrequent basis, if it is on a one-off basis, and you are prepared, you think, but it also depends on the nature of the business. If the nature of the business is of a kind, of a routine kind, or of a which you can only appreciate, that it does not amount to assuming a great risk. So it depends. But generally speaking, one should not be borrowing to invest, and by extending that logic, one should not be putting our long-term investments as a collateral against any borrowing.
Next up, Mr. Arunachalam asks if you could explain what are the equity savings funds.
It's a new nomenclature which has come, and there are different companies actually configuring it differently. But the basic idea is that it is a third into equity, a third into arbitrage positions, which actually gives it the character of it is of fixed income. The risk profile is of a fixed income, but the tax advantage or tax treatment of this investment becomes big, because putting a third into equity and a third into arbitrage position makes it an equity fund, and another third is in fixed income. So these are conservative allocation funds. 33% into, a third of it into equity. So think of it as like MIPs, which will be treated like equity funds from a taxation point of view, which is beneficial because all your long-term gains becomes tax-free, and little more allocation than a MIP, because most MIPs don't exceed, don't go beyond 15-18% into equity. This can be 33%. So these are low risk, relatively low allocation to equity, trying to and these funds, from a utility point of view, what kind of investor should look at it? I think conservative investor trying to seek income from their investment and not wanting to assume great risk, even the kind of risk which you assume in a balanced fund, which is 2/3 equity and remaining in fixed income. These are more conservative than that. So these are very desirable funds for very conservative investor seeking reasonable return with great stability.
Padmavati asks, what is the advantage of dividend reinvestment plans?
There is no advantage of dividend reinvestment plan. If you are in, except that it has historically been there, There were initially most funds had dividend plans. Then a lot of investors wanted that they don't want the return, they don't want the dividends, so the growth plans were introduced. Now some investors who have chosen dividend plans and they don't want dividend, it serves the purpose that the dividends will be reinvested. So if the effective treatment of your investment becomes that it becomes a growth plan. But if you are choosing a fund and at the time of investment, if you know that you don't, and with most equity investment which is meant for a long term, which is your long term investment, your idea is to accumulate capital over a period of time, and no amount of income, periodic income, is not your goal. You should choose a growth plan. If you have invested in a dividend plan for some reason, or you did not have appreciation of the subject or the nature, and now you realize it, moving your, giving an instruction to change your fund from dividend to dividend reinvestment happens seamlessly. It is a non-financial transaction. If you want to convert your dividend plan to growth plan, this will amount to redeeming your investment from the dividend plan and making a fresh investment in the growth plan. When you give an instruction, if you don't want the dividend, you can give an instruction to the fund company, and the dividends will be invested in the fund without any load, and you will be issued more units. So the effect on your money actually becomes that of the growth plan.
We have a flurry of questions today, Dhiren, so we'll extend the duration of today's session
Sure.
a bit to accommodate a few more. Thanks. Next up, Gagan is investing in a couple of small cap funds whose sizes have grown substantially. Now he asks, should he continue his SIPs in them or shift to other funds?
Yes, I would say that size is going to be a very significant deterrent, or is going to be a barrier to the performance of many of these funds. Size in itself can actually blunt the performance, and also not to forget that small cap funds or the mid cap funds have done very well over the last 2-3 years. But reversion to mean and cyclicality of the market is the ultimate truth. You should believe in that. And if you are getting very excited or impressed by the returns of these funds and have developed a great belief, diversification is a mantra which you should not forget. And so consider a more diversified approach to investing. Make sure that these small caps, mid caps are not the all of your portfolio, and this is about time you correct it, even if it amounts to losing out on some opportunity or losing out on potential gains in the near future. I think over a period of time, in a 5-year, 10-year, 15-year cycle of our in our life, it is not material. It will actually things revert to mean, and it is something which should not be, you should not forget, and it will happen even with small and mid cap funds.
This next one comes from Jagdish. He says that though VR ratings are very useful, but how does he choose between from the categories of funds which are unrated?
I can't think of any meaningful category which is unrated. And if there is a, there are some categories which are unrated, but they are either unrated because they do not form a homogeneous set. For example, our international fund, we do not rate international fund because all international funds are different. There are 3-4 US oriented funds. Then there are mining fund, there is a Brazil fund. So even though we call it as an international fund, it is not a homogeneous fund set. They are not of the same kind. They behave in a very erratic manner. The only common thing about them is that they invest abroad. So that is one category we do not rate. There are other categories which we do not rate simply because there are not enough funds in those categories. Then there is another category which we do not rate for the same reason as international. We have a category called equity others, which we do not rate. We do not rate them because they are all varied kind of fund. And generally speaking, you should avoid. In fact, you should look for the international fund. We think that investors should invest in international fund. They should invest in them. And for now, they should invest in them without a rating. And you should choose the right kind of fund without the guidance of the rating. Otherwise, in all mainstream categories, our rating is useful. The other categories in which there is no rating, I think that itself is a good signal that you should not be considering them.
Next up, Ravi asks if the number of funds in the portfolio should increase with increasing size of savings.
No, I think you should depends on what is the scale. If your portfolio size becomes very large, so large that it becomes a threat to the fund, uh, you should have that principle. But I don't think any individual has to worry about that. I will worry when I as an investor become 10% of a mutual fund. If that is not the case, I think most investors with few crore rupees, or even uh, few in the multiples of tens, if you have 40-50 crore rupee, I think you are still okay to be investing in 2-3 funds. You are reasonably diversified. I don't think you need to necessarily add funds, because by virtue of 3-4 funds, there is a possibility carefully chosen 3-4 funds of different kind will ensure that your portfolio becomes the underlying portfolio will be 100-120 stock, which I think is a fair diversification and good judgment. You don't need to necessarily add more.
Next up, Mr. Shankar asks, how can one keep track of one's direct investments?
In fact, to track direct or regular or any investment, come to Value Research online, set up your free account, upload your account statement, and visit it whenever you want to. Uh, and you can track all your direct plans uh, or regular plans wherever you have invested. And if you want to if you want to do the exploration of the direct plans, Value Research online actually provides you information on direct plans as well as regular plans comprehensively.
We'll take one last question for today,
Sure.
Dhiren. Ajay asks if there are curbs on fund manager salaries and expense ratios, and if there is any penalty if a fund underperforms.
Uh, no, there is no curb on his salary. There is a law on the expenses. Mutual funds are supposed to charge expense within a limit, and that limit is 2.25% plus service tax plus B15 incentives. And these expenses must come down as the fund gets larger. As for every incremental 300 crore, the fund expenses should come down by 25 basis points. So there is a limit on the expenses, and it works, and they are pretty high. They need to come down over a period, or they should come down as soon as possible. There is no limit on their salary, and fund managers are not penalized for underperforming their benchmark, but there is a penalization because fund companies earn money when based on the amount of money they manage on a daily basis. They are allowed to charge the expenses based on a pro rata basis every day, 2.25% for the amount of assets that they manage. So if we put our 100 rupee and the fund manager is unable to grow that money, the fund manager will earn on 100 rupee. If there is another fund manager who is able to grow that 100 rupee to 150 rupee, then the fund manager will earn on 150 rupee. So if they do well, they earn more. If they don't do well, they don't earn well. And there is no penalization for underperforming the benchmark, but there is a penalization if a fund consistently underperforms. Fund investors take their money out, and new investors don't put their money in.
Thanks, Dhiren.
Thank you.
And any concluding remarks for our viewers today?
Yes, I think most investors, based on the discussion that we had right now, you can choose Kaunsa mutual fund Sahi hai, you can figure it out yourself. And we are always there to guide you. And try and keep it simple. And the biggest contributor or the biggest input to Kaunsa mutual fund Sahi hai lies with you, not with an expert.
Thank you, Dhiren. Thanks everyone for joining in. We look forward to your presence in our next session.